Mish, nice to have you with us. We talked earlier about the Canadian jobs report. We got a U.S. jobs report today, which was quite strong. But we're at a point in the market where people look at those new numbers on jobs staying strong as a clear sign that more rate hikes are on the way. What can you tell us about your reaction to the markets today?
Well, it was good to see that the employment numbers were good and there were jobs added, but it doesn't tell the whole story, right? Because labor participation was actually down, and we still have 11 million jobs open. So basically what's happening is people are either getting laid off and not looking for jobs, and there was also a statistic that some people are still quitting jobs, part-time and full-time jobs, which means the labor situation is better, but it's still not really great. But of course, what we do know about the Federal Reserve is based on the numbers they saw of the 3.6%, that's going to be enough for them to look at, to say for the July meeting, probably that 75 basis points, because John, we've talked about this. Powell is totally focused on inflation and not too worried about the economy.
And so what does that mean for the investing landscape? Mish, we're now into the second half of the year. A lot of people trying to figure out the flows of funds over the course of the next few months.
Well, there's a couple of things. Number one is if we truly are, which I believe we are, in a stagflation environment, and even Bullard didn't use the word yesterday, but suggested at the fact that since the economy isn't growing, it doesn't mean it's slowing. Well, what does that mean? Stagnation, number one. But number two is that we are in a really unique period of time, as July is, as you just mentioned, the second half of the year. And many investors will actually rebalance their portfolios. And very often they will wait for the first 2 weeks of July to go by. So we're looking at maybe one more week of trying to establish some kind of a range. And then after that, the way we break the first 10 trading days of this month, I think will be extremely telling about whether or not we're seeing another leg down, or whether or not people think that even though the Fed's going to raise, they're going to drive us into a recession, and then they're going to actually relax and accommodate, in which case we'll avoid recession, but then we'll essentially also avoid inflation, which, I mean, is so perverse when you think about it, but that's kind of what the market's saying right now.
I'll tell you, you could spin your head all day on this stuff. For people who are trying to make different sector calls right now, let's key in on commodities. You've talked a lot with us about them in the past. I mean, certainly we talk about oil, but natural gas, sugar, copper, these are all areas that you're watching right now. We had recently, obviously, on the recessionary risk, seen some commodities, copper for sure, losing ground. But what do you keep in mind when it comes to commodities right now?
Well, a couple of things. One is Europe, which is still having tremendous issues with gas and energy, although our oil market has come off, and maybe it has peaked, but peaked is very different than it's going to decline. And then if we look at going back to copper for a moment, what's really interesting about copper is that, yes, it definitely will go down in a recession, but it also has had a tremendous dislocation compared to the supply and the cost of mining new copper. So if we don't go into recession, it could actually go right back up because it's huge in the usage of electric vehicles. And then looking at the soft commodities, sugar is a tremendous play. We have food crises all over the place. Even Norway reported today food poverty increasing, Spain, England, here in this country. And so sugar is really key to watch because it also is, believe it or not, a good indicator, even more so than precious metals or even grains, because it's something that people go to when food is expensive because cheaper food has a lot of sugar. But it also can point out possible new leg up of inflation, particularly when it comes to food. And then also geopolitics gets involved too with all of this. So no matter how many times I put it in my own head, I still think that we saw dislocation again, to use that word, in prices, a counter trend within a trend of higher commodities prices. And of course, CPI comes next week, so we'll see what happens with that.
And quickly before we go, just to talk about another pocket of the market, we have seen weakness in growth. Technology stocks have really struggled. Kathy Wood, who runs the ARK Innovation ETF, the star of the last couple of years, obviously has been put to the test here. She still has a loyal following, but her ETF, which has names like Zoom and Tesla, Roku, Canada's Shopify's in there as well. What would you say about the outlook for some of these really beaten up technology names?
Well, what we have going on right now with ARK is that it had sort of what we call a mean reversion trade, which means that it got so oversold that eventually it has to restore itself to the mean of some average price. Of course, we don't really know what that average price is yet. But we actually advised our clients to buy ARK because if for some reason we will be able to muddle through whatever the Fed policy is, if inflation has really peaked, if we don't go into a serious recession, I think her portfolio is an interesting place to be. So we got in on Tuesday, which was good. We got in early on the game. But I think it's key to watch because if it cannot go up much higher than $47, which it sort of tested today, share and starts to back down, maybe back under 44, then it's telling you that this was just one of those little short covering rallies and most likely more pain in store for these tech companies.
A lot of